Markets have tanked since the Fed pulled the trigger on raising interest rates last month, and investors will be watching for any shift in policy to account for the recent market turmoil. I want to bring in TD Bank, head of corporate banking right now, Braca. Greg, it is good to see you.
Good morning.
Thanks so much for joining us. First, your expectations from the Federal Reserve.
Well, I think we'd love to have a reset since the start of the year, get these markets and go back to 12/31, get a redo. But I think the expectation is clearly there'll be a pause in January, and I think you'll decidedly perhaps hear some language tomorrow that this will be a data Fed decision as we get later in the year, and perhaps a little bit of a reversal of the language around 3 or 4 rate hikes for the balance of 16, and we're beginning to think that maybe it may be 1 or 2.
And that's pretty appropriate, right? I mean, when you look at the backdrop of the economy from where you sit in terms of lending, how does the economy feel to you?
You know, it's funny, notwithstanding the choppy couple of weeks in the markets, it actually does feel quite strong. Last couple of weeks has been a decidedly risk-off environment across all asset classes, whether it's high yield, commodities, equities. But clearly, we do think that there is a fairly strong fundamental underpinning, whether it's right here, real estate markets here in New York, or the M&A market. You know, we're coming off a very, very strong 15 around M&A, investment in CapEx, and we do think that strong underpinning of jobs, GDP, will continue once we get past this choppy period.
But is this a payback for the excessive risk-taking that the Federal Reserve and other central banks encouraged with this unprecedented monetary policy since 2008? That you're essentially encouraging people, you're deeply indebted, so that the Fed and all these central banks said, hey, well, then you should borrow money at cheap rates and then take incredible risk with it. And there's going to be payback, and once it starts, can you even stop it?
Yeah. If we thought this recovery and this way out globally was going to be completely without some chop to it, I think we were all kidding ourselves. And while it's been a gradual climb out over the last 7 or 8 years, I would say we do clearly believe that the U.S. market is relatively stronger than what's going on around the rest of the globe. We do believe that GDP is strong, the job numbers are strong, whether it's the commercial real estate price index, auto sales, and overall fundamentals. We do think that there is a strong underpinning to all of this, and we just don't think that this is built on air.
But when do you think the market's going to reflect this? When do you think we're going to not see so many drastic swings in volatility on a daily basis?
Yeah,
well, or maybe things were overvalued going into 2016, right? When you just look at prices.
Yeah. I mean, we've had very strong capital markets, obviously, for the last 6 to 7 years, and it's kind of been a one-way bet up. And you know, a little correction and a little risk off and a little pause. We probably all would have agreed that we wouldn't have wanted to see it as choppy as it was. Uncertainty and certainly the devaluation of commodities and other things. But underneath all of that, though, if you think about the consumer, you know, we keep avoiding this headline that this is real dollars, whether it's gas prices, commodity, cost of imports abroad. This is really just feeding a strong consumer story in the U.S.
Let me ask you about what I asked you during the commercial break, because I think this is a really important point. You mentioned the M&A environment, and we know that mergers are just on fire. I mean, we know that Johnson Controls and Tyco having this huge bet, that's going to go through $14 billion, and then they're going to take the headquarters to Ireland for lower tax rates. Are you seeing much of the lending that you are seeing as a result of M&A, or are companies borrowing to actually investing in CapEx and in their businesses?
The very large companies and the deals over $5–10 billion. Obviously, 15 was a record-setting year, and TD was certainly a big part of what was going on in the market there. But really, even down throughout the ranks, smaller companies, middle-market companies, we are seeing a core demand out there. And in fact, TD, we did a CFO survey of several hundred companies towards the end of 15, and decidedly, the information that we've gotten back, and it's what we're seeing real-time in our numbers, is that whether it's commercial real estate, autos, you know, various industrial companies, there is a commitment to invest in CapEx, infrastructure, technology,
it's not just for M&A.
It's pretty broad-based.
They are investing in CapEx, because we've been waiting for that for a long time, corporates to invest in CapEx.
We're seeing that real time. We're seeing them take advantage of their balance sheets. Obviously, the balance sheets have become very liquid. Access to capital has been terrific. Interest rates are still relatively low. And I know we want to constantly talk about these quarter-of-a-point rate rises, but when you're really talking to these companies, it's really an afterthought whether it's the rate's 50 basis points or 75. It's still historically and in perspective all-time lows.
Really good stuff, Greg.